When a company is circling the drain, most people expect vultures to swoop in and pick apart the remains. But what's happening with Wolfspeed right now completely flips that script on its head.
Let me tell you why this caught my attention. Apollo Global Management just made an unexpected move by bringing in Moelis Company, and it's like watching a chess master make a surprising play that changes the whole game.
You know what's fascinating about this? Apollo has $1.5 billion in senior secured loans to Wolfspeed, which normally would mean they'd be first in line to grab assets in a bankruptcy. But instead of going for the quick cash, they're playing a much longer game here.
So what you're saying is they see more value in keeping the patient alive than selling off the organs?
Exactly right. And here's why that matters. Wolfspeed isn't just another struggling tech company. They're one of the leading manufacturers of silicon carbide semiconductors, which are absolutely crucial for electric vehicles, 5G networks, and military applications. We're talking about technology that's fundamental to America's industrial future.
Well, that explains why the CHIPS Act funding is such a big part of this equation. Wolfspeed could potentially receive hundreds of millions in government support, but only if they stay financially stable.
And here's where it gets really interesting. Moelis isn't your typical restructuring firm. They're known for what I'd call financial diplomacy. Instead of coming in with chainsaws and sledgehammers, they bring in negotiators and problem solvers.
Hmm, that reminds me of how different this is from typical distressed situations. Usually, when a company's in trouble, you see a feeding frenzy of creditors all trying to get their piece first.
Right. And let me tell you why Apollo's approach is so clever here. They have this thing called a make-whole provision in their loans, which means they're guaranteed to get paid back under certain conditions. So forcing a bankruptcy actually might leave money on the table for them.
That's exactly why the market reacted so positively to this news. Wolfspeed's stock actually bounced when this was announced because investors realized this wasn't going to be a typical corporate dismemberment.
You know what's wild about this whole situation? The cost of bankruptcy would be astronomical. We're talking tens of millions in legal fees alone. But the bigger cost would be losing access to government funding, potentially losing their contract with Renesas, and watching their top engineering talent walk out the door.
Well, that brings up an important point about talent retention in the semiconductor industry. Once your best engineers start leaving, it's almost impossible to recover, right?
Precisely. And that's why timing is so crucial here. Moelis needs to get all these different stakeholders, Apollo, Renesas, the convertible note holders, and others, to agree on a solution before the company runs out of runway. It's like performing surgery while skydiving.
Let me add something interesting about Moelis' track record. They've successfully handled some of the most complex restructurings in recent history, and they typically achieve out-of-court solutions that save companies millions in bankruptcy costs.
And here's what I find most fascinating about this whole situation. It's showing us how the traditional vulture capitalism playbook might be evolving. Instead of strip and flip, we're seeing more sophisticated investors looking for ways to preserve and grow value.
So what you're suggesting is that this could become a model for future corporate restructurings.
Well, in industries where intellectual property and human capital are the main assets, I think we'll see more of these collaborative approaches. The old model of liquidating physical assets just doesn't make sense when your real value is in patents and people.
Let me tell you why that's such an important shift. It could mean the difference between keeping crucial technologies and industries in America versus watching them disappear overseas.
Looking ahead, I think this situation will be studied in business schools for years to come, either as a brilliant example of modern financial engineering that saved a crucial technology company, or as a cautionary tale about the limits of financial diplomacy. Either way, it's reshaping how we think about corporate restructuring.
Well, this has been absolutely fascinating to unpack. We'll definitely need to keep watching how this plays out.
Without a doubt. And remember, sometimes the most important moves in business aren't the ones that make the biggest headlines. They're the quiet decisions that keep innovation alive and companies moving forward.